love and fear, I wanted to talk about love and fear, and I know that's a little on this edge there, but really staying present. And a financial advisor allows you to stay present and allows you to keep the noise of the world out of your life. Your life is far too precious and far too important to be distracted by all the noise that's out there. And we want to help you stay present and focus on all the great things that you can have in your world.
Welcome to One with the Other Way, a podcast about your journey in finances. I'm your host, James. We have Wanda with us today. Today's episode, we're going to be talking about market fears. And that's kind of a broad, vague statement, but I think we can kind of go a little deeper into it. Wanda, if you want to hit us off with a little bit of a summary of what we'll be talking about today.
We're going to talk about one of my favorite topics in the office, which is market fears. As humans, we operate with two emotions, love and fear. And I want to talk about a little bit more about the first at a later point today. But let's talk about fear. We are completely afraid of the unknown. And so that brings me to the second point of today. Truly, we want to stay present in this moment for the information that is available to us and what we know. And financial advisors can be very useful in determining what we know, the known things, right? And allow us to stay present. There are so many things that could happen in the market. I mean, it can go up and it can go down. So many possibilities, but really it's going to go up and it's going to go down. I feel like I'm in really good shape in my office in terms of market fears because I have a couple tools that I use. First, I have a crystal ball. Okay, past performance is not an indicator, and maybe I don't rely on my crystal ball so much. But when the question comes up about market fear, it does make us smile to think if only I could have that crystal ball. And in fact, I do, so I feel really good about that. It's like you have to look at that in a humor sort of way. I don't think anyone wants me to roll a dice, but I do have that there in case people are like, which direction will the market go? Will it go up or will it go down? I have a dice. We can roll the dice and see. And then if that fails, right, and we can't address your market fears that way, then we will just consult the magic 8 ball and see what the magic 8 ball says. What's the magic 8 ball say today? The magic 8 ball says it is certain. It is certain that the market will go up and the market will go down. When we think of market fears, it's the unknown. Mm-hmm. But actually, you do know the market's going to go up and down over time.
You brought up the word bull market. Mm-hmm. And I think we should quickly kind of go over definitional senses for those who don't understand. Yeah. What's a bull market and what's a bear market?
Yeah, generally the bull market has to do with when the market is going up, and it actually has its roots. So when a bull fights, right, it takes its horns and throws it down and throws you up and over. So it's an upward movement, and there's your bull.
Bear comes down.
Right, and
that makes sense.
Right. That's where we get those words, bear and bull. And then definitionally, a lot of times I hear that word 20%. If it's an adjustment of 20% is something that's used to say, oh, hey, this is a bear. But
generally it's interesting they chose such violent language.
I know, right? And included in the equipment in my office, I do have a bull and a bear, and they are on a seesaw because it's one person's turn and then it's the other person's turn. So
it's funny. Yeah. Your last name is also Toro.
Mm-hmm. Exactly. And so the only collection that I actually have is a collection of bulls because I'm all in for bulls.
We were just talking about bulls, bears, and we're talking about having fear. Market volatility, going up and down often. Mm-hmm. I think in a previous podcast, we had mentioned the idea that by the time the investor or the normal everyday public finds out about something in the news, it's already too late.
Yes.
So how does a financial advisor help their clients understand that, hey, this is something that we do our best to predict, but we don't have full insight to what the market's going to do?
Right. So understand that the market represents the broad American economy. And so when people have fear associated with the market, I do ask the question of, do you think every single company in America will go out of business? That's not going to happen. The market will go up and down. Interestingly, the average low in a year is 14%, according to JP Morgan. So every year, we'll see a 14% adjustment downwards.
Mm.
So when we're doing financial planning, we can look and say, hey, where are we on this curve? And, it's normal to have that close to like about 15%. So my dollar is worth 85 cents and on any given day. But when you talk about volatility, it's really directionally, you're thinking up volatility up and down. How much movement up and down? And so if the market's down 14%, it could also go up 14%. We find that even with the market lows of that 14%, 32 out of the last 42 years, the market has ended the year in positive territory
Mm.
in spite of the 14%. So when we're working on a financial plan, we have to understand that $100 could be worth $85 on any given day, or it could be worth more on the other side. And really, the sky's the limit on the other side. You see some great returns in the past couple of years.
Well, so talking about going down for a second, mentioning market crashes, and you said, will all businesses go out of business? What's the likelihood of a crash here? Because I
So,
feel like that's a question people might have.
right. I strongly discourage the use of crash. There is no real crash of the market. There's adjustments in the market. And when I say that all companies go out of business, not all companies go out of business. All companies have business cycles and they move based on the business cycle. So you have to think that American Express, when it very first started, was actually a logistics company that moved supplies and equipment out to the West when America was exploring the West. Now, arguably, American Express moves money. And so it's changed its business model and has gone through a lot of different business cycles over the years. It's been around for a long time. And you see that also in the Wells Fargo logo, the little stagecoach. That's
Mm-hmm.
the business cycle, right? Generally around 6 to 8 years. You see that with Apple phones, okay, they have a new idea. Currently, right now, last couple of years, a little bit of struggle because they're coming out of a business cycle and then they're looking into the AI world, and it appears that they have found a resurgent space to be working for the next new idea. Not coming up with the next new idea for the company puts them out of business. So Kodak,
Mm.
right? Kodak.
Yep.
Oh, they thought everyone will always have pictures, but now look at us. We don't do gone
It's all
are
on your
those
phone now.
films. I know it's all on your phone. So businesses have to be open to the next thing. Blockbuster videos, right? They did not recognize the online space and how they could operate in it. And then some companies do transition, and that has to do with their business plan. To the point of, we talked previously about fund managers being able to sit in company board meetings to say, hey, is this a company that's forward looking? Are they looking past the current business cycle? And is this a company we need to invest in for the long term? I want to address the crash thing, though. People do talk a lot about crashes, and there really is no crash, right? America has never gone out of business since its inception and will continue to be strong. There have been some interesting adjustments or some adjustments that have taken us aback a little bit. And most recently, of course, COVID, which was a 34% correction in March of 2020. A 34%. That meant my $100 was worth what? $65.
Oh my.
Yeah, yeah. Not a crash though. A serious adjustment though. If you're looking at your statement that's during that time. Interestingly, in the COVID adjustment, it only took 2 months for the market to adjust back to the highs previous to COVID, like
Mm-hmm.
previous to March. It only took them 2 months. And then if you go back historical, right, a little bit, a lot of people are familiar with the 2007, 2008 housing crisis. How many years ago was that? That's what?
It's been 16 years,
16 years. So in our
right?
lifetime, most of us have a familiarity with that. So the market saw an adjustment downward in November of that year, 2008. And then we actually recovered a few months later, only to have another major adjustment in the following spring, like March, April timeframe. That's 2009. That was a 56% correction. That
Oh
meant your
my gosh.
dollar was worth, right, $44. How long do you think it took to correct during that one?
I feel like the ripple effects of the
Hmm.
2009 took a long time.
Yeah, forever, right?
Yeah.
We remember that, by the way. That's in our mind and we draw upon it. Put a number on it. What do you think it was for year? Just a minute.
Probably a couple years at
Yeah,
least,
it took
maybe even.
exactly 2 years, right? So you could have cashed out at $44 to the 100, right? With that 56% correction. But if you just waited, you got your $100 back 2 years later.
Yeah.
So that's the other thing that people say is, oh, I lost all my money. Well, you only lose your money if you cash out. If you looked across America in 2002, 2008, yes, we were struggling, but we were not in the business of going out of business. Choices
Mm.
and decisions had to be made, and policymakers and investors were making them. And I have trust and confidence in my fellow human beings that they do want to get to a better place. Nobody wants to be suffering from a housing crisis. We do want people to have the things that they want, to include the homes that they want.
Hmm.
And then I'm going to date just a little bit right back to the previous adjustment, right? So these are the
The
three major
dot-com bubble
adjustments, right? The dot com. A lot of people know about that. And that's actually, a lot of people are looking at today's market and wondering if that is reminiscent
was so
of
tech
what's going on.
related.
It was very tech related, and we had stocks that were overpriced based on what they were earning. Remember, we talked
Mm.
about PE ratios, or price to earnings ratio. They were over heavily inflated during those years. And some people arguably would say that's what's going on a little bit with technology right now. The Mag 7, and we've talked a little bit about that. And that actually was a struggle that it was started in 2001, right? It adjusted downward again in 2002, and then it again and later in 2002. And it bobbled around down there at the bottom and did not recover for a couple of years. Same thing, 49% correction. Your dollars was worth
Half of the
$51.
value.
Yeah, yeah. Did you waited a couple of years and you were fine. So those are the three major ones. And in our lifetime, and we always remember the bad things. Sometimes I think we remember the bad things and we don't remember the good things, like the 2007, 2008 crisis. That sits heavy on our mind because, like, what if that happened? Yet the reality is that you will live for 80 or 90 years. We have a 90-year lifespan in general, right? Sometimes we'll go a little bit sooner. And so I think the thing the takeaway on market fear is definitely to understand that the market will go up and down, and it will go up and down in your lifetime, because we're talking about the last 25 years, and that's been three major corrections, but corrections that have been corrected during that time period.
Hmm.
So it's nothing that has lasted forever, so to speak.
That's true. I guess, yeah. But the fear still exists, and the reactionary responses to market fluctuations are still drawing people to make decisions, correct?
Yes, the behavioral responses that we make and the things we tell ourselves cause us to take action when maybe action is not required. So another interesting study that has been done, and I think maybe we can source it on the footnotes, but the average investor makes 3%.
Really?
Mm. Yeah. So
Without
so
an advisor, or is that
without
just.
an advisor, yeah, the average investor makes 3% without an advisor.
And
Why?
what's with an advisor then?
So an advisor can help keep your emotions in check and
Mm.
remind you about the big picture and the decisions made moving forward. And that is worth its weight if you think about it, because 3% is barely keeping up with inflation.
And that's not even considering what we had talked about at the very beginning was being present.
Yeah, yeah, being present. So a financial advisor can remind you and put a little perspective on what's going on in the adjustment of the correction, and say, okay, where does this present lie in terms of your overarching lifelong story or your real life? And then put that perspective on it so that you're not making decisions that are permanent about temporary things that are going on in the market.
Well, then that leads me to think about, we have the media, for instance, that
Oh, Lord.
makes comments on things
Mhm.
and can install fear. I mean, I can speak personally. Every time I see the news, I feel like there's something, either it's the best thing in the world about the market or it's the worst thing in the world about the market. How does an investor know how to respond to that?
This is interesting because a couple things. First, I've often heard it said, if it bleeds, it leads. If it's exciting and it bleeds, it leads. And so the media is always trying to latch onto something and make it more important than it is. And so I'm going to read the article, and then I'm going to see, and then I'm going to wonder, is this going to affect me? And the reality is, it probably doesn't affect you at all, as most news stories don't affect us. And we spend too much energy on the news, as entertaining as that could be.
So, how does an investor then work with the financial advisor in determining their risk tolerance per se.
Yeah. Risk tolerance is another interesting topic. I feel like I use the word interesting quite a bit. It is interesting though. People are like, I would like to invest aggressively. Well, what
Hmm.
does investing aggressively mean? Well, that means that the company has more upside potential. What's not to love about upside potential? But a company that is aggressive is more volatile than a company that's not as aggressive. And
Mm.
that company has the same opportunity to go down and out of business. And so when we think about the next new idea, you will find that those companies have a lot of volatility up and down. And it can be upwards of 30%, right? $100 being worth $130 one day and $70 in the next day. If you say, I want to be an aggressive investor, right? I don't want to be looking at it daily. So figuring out how aggressive you want to be, a financial advisor can help clarify that. Hey, look at your account here. You see this $10,000, you would like to be aggressive. Okay, that account on any given day can be worth 13 between 7,000 and 13,000. Are you going to be able
Hmm.
to sleep at night when it's 7,000? Right?
That's quite volatile.
Exactly. Looking at your numbers, taking the emotion out of it can be helpful to understanding where it fits into your life. You may, in fact, be aggressive. You might be young enough and you might be able to be aggressive because you've got another 40, 50 years to go.
If there's the aggressive side,
Hmm.
what's the more stable side?
If you're aggressive in the market, generally you're looking at ownership and equity in companies. And if you're more conservative, then you're generally looking to the bond market, which is really lending companies money. And those companies give you dividends and then return money on the coupon, similar to US treasuries, that kind of
Mm.
thing. But you're capped on the amount of money you can make on the bond, but the volatility isn't as great. So you're going to
Mm.
get some consistent dividends, right? Depending on the type of bond it is, 2, 3, 4, 5%. And the volatility, the range will be very, very narrow versus in the equity on the stock side, right? The equity can be, or the volatility, the movement up and down can be, well, the sky's the limit on the top side and zero on the other side. So a
Yeah.
lot of room, and you're trying to stay in the center there. And again, talking to those risks can be helpful to understanding so you can address that particular fear.
Where does diversification fit in this?
I wonder that we need to have potentially a diversification podcast because when we're in a mutual fund, we're diversified in the number of stocks that are within the mutual fund. It's also of note that over time, American Funds has done a study that says the fewer stocks that are held in a portfolio, the better the portfolio will perform over a period of time.
Interesting.
I know.
That kind of
Um,
goes against the grain of what diversification says.
Yeah, so you want diversification, but you want diversification with the right companies. You want diversification, the companies that are going to stand the test of time and earn you money over time. And so that's the right diversification. No more than that.
Mm.
Not everything in the store, just the thing that you need. And taking a look at the diversification of a mutual fund, I think, is an important aspect of financial planning and taking a little of that fear out of it.
So then, as an investor works with a financial advisor, how often should the investor be rebalancing their
Right.
accounts?
Right. They've done studies about rebalancing accounts, and you can rebalance daily, monthly, quarterly, annually. And actually, a daily rebalance is nominally like 0.01% better than an annual rebalance. So the amount of work, effort, and a cost associated with a daily,
May not be
it
worth it as
may
much as
not
it
be
might
worth
be
it.
worth to do an
Right.
annual checkup.
But annual checkups should be done.
Without trying to get too technical, maybe, unless it's necessary, what is dollar cost averaging? I feel like that's something that needs to be brought up.
I feel like that's a big one that needs to be brought up, as a matter of fact. Thanks for bringing it up. So, if the market goes up and then the market goes down, and you're investing $100 or $300 per month, you will find that if the market is down, you get to buy more shares than when the market is up. Our emotions sometimes get in the way because they're like, oh my gosh, the market's down, it will never recover. But we've already talked about the market recovering. The median bear market only lasts 13 months, just Medium.
And what's the length of a bull market? Isn't it like 7 years?
Yeah, 7 years. So a long time. You're mostly in bull markets. Again, we always remember the bad things, not necessarily the good things, with one exception.
Mm-hmm.
We always remember like our winners, the time we got the real bargain or we made the best buy, right? I got that best deal. We'll remember that. We'll forget our losers, our personal losers. We'll have people like, they'll say, oh, yeah, I got Apple when it was this. Oh, what a great time to get Apple. But they'll forget the other, nine stocks that they did not do well with, or that kind of thing.
Mm-hmm.
So, but in general, our emotions, we tend to remember the terrible things and not necessarily the good things. And then 32 out of the last 42 years, think about that. The market has finished in positive territory. So just being in allows you to make money.
So does dollar cost averaging mean the value of your dollar is honestly greater when there's a bear market, so you can
It's
buy more?
Yeah, it seems that way. We have no problem going to the store and looking and saying, oh, hey, look, they're having a sale. I'm going to buy more of that item. And so, needless to say, the dollar in a market that's down has the opportunity to buy more share. The important thing is shares of what?
Yeah.
Because Kodak, remember, when they was going out of business, had its shares on sale. But is that where we want to be? Tesla right now is struggling. Is that where we want to be? To the point of having a professional fund manager actually look and say, yes, this is where we want to be, because they have the next new idea.
Mm-hmm. And how does working with a financial advisor help with this idea of dollar cost averaging, going through
Right.
taking away some of this emotion out of it?
Right. So finances for real life, we keep you in the market. We're going to do everything we can to keep you in the market, making recommendations that are suited to your risk tolerance and
Mm.
your life goals, and your upcoming dreams. Right. So if I'm retiring next year, it looks a little different than if I'm switching jobs, or if I'm having a baby, or if I'm just moving into a bigger house or having a promotion. Each of those stages of your life have different needs from a financial planning perspective, and you want to take a look at those.
Depending on where you are in your age and
Mm,
your risk tolerance,
mm.
how does someone respond to negative corrections or downward corrections in the market when they are closer to retirement, when there's probably more fear involved?
Right. Stand back and talk to a financial advisor, ensuring that you have an adequate cash flow going out of retirement. And we've talked a lot about that in retirement income, I think.
Mm-hmm.
And so it may be that the market is not cooperating when you retire. We're going to put some perspective on it, and we're going to do some analysis to determine how that's going to affect you. If you were to retire during one of these major adjustments, there are tools that we need to use to ensure that you have retirement income for the rest of your life, no matter how many more years you have to go. I wanted to talk last about my little pet peeve. I think as humans, we have feelings and emotions and all that, and I think
How dare we?
I know, right? I read a book, Conversations with God, and he said that basically there's two emotions in the world: love and fear,
Mm-hmm.
and all of our actions are out of love or fear. And so when I love, I am willing the good of you. And when I'm fearful, then I'm suspicious. And so when we look at market fear, there's suspicion. And really, you want to look at it from the other side of the coin, as willing the good of the other.
Mm-hmm.
You're investing your money in the market, and American companies are stronger for it. And in return, you can have the life that you want. And what a great life.
Yeah.
So, love and fear, I wanted to talk about love and fear, and I know that's a little on this edge there, but really staying present. And a financial advisor allows you to stay present and allows you to keep the noise of the world out of your life. Your life is far too precious and far too important to be distracted by all the noise that's out there. And we want to help you stay present and focused on all the great things that you can have in your world.
In order to do that, you can schedule an appointment with Wanda or Peggy if you'd like. You can find us at financesforreallife.com. And you can also keep in touch on our podcast every 2 weeks. And we hope you enjoyed this episode, and we can't wait for you to hear more. So thank you for listening, guys. This has been One Went the Other Way. Hope you have a good rest of your week. Securities offered through LPL Financial, member FINRA, SIPC. Investment advice offered through Finances for Real Life, a registered investment advisor and separate entity from LPL Financial. The opinions voiced in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a decision.